Zina, we knew inflation would be an issue, and we knew the Fed would get a run for its money. But now that the numbers have come through on Friday for CPI and the reaction that you've seen across assets, does that warrant a bit of a change, a bit of a tweak in what you're telling your clients?
Absolutely. I mean, may you live in interesting times, as the Chinese proverb said. The CPI figures spooked the market indeed, and led the market to believe that the Fed will need to be more hawkish, potentially doing a 75 basis point hike tomorrow and another 75 in September. On one hand, inflation is still not completely unanchored, as the 5-year break-even shows. But on the other hand, we think that the Fed will need to be more hawkish, that a soft landing is starting to become more difficult, and therefore recession risk is starting to become more imminent. This is what we've seen in the yield. We've had flattening and also an inversion across the curve. So we maintain our IG mid-duration versus high-yield preference.
I mean, I look at the JP Morgan spread from Gulf bonds over treasuries, and you know, we've kind of come off the highs, but that spread's likely to increase again. The question becomes whether the Gulf Cooperation Council is really an ideal place to be, because that's the argument you're making. What's the thinking behind that?
I mean, absolutely. With oil at, 120, the region is obviously in a better state fundamentally. There's less need to refinance. And I think that the region should press forward with fiscal reform, given the good fundamentals at this point. It also benefits from the geopolitical uncertainty with an inflow of capital to the region.
Will oil endure at $120 a barrel, in that range? Is that kind of what you've put out there? Because if there's going to be demand destruction, if there is going to be a recession, you know, all these bullish oil calls are going to come back in and come back down.
Absolutely. I mean, if we start seeing a recession globally, the lockdowns are going to impact oil, but these are medium to longer term. We think that oil will sustain at these levels in the foreseeable 6 to 8 months time horizon.
Egypt has been a trouble spot in terms of the losses that carry traders have had to kind of deal with, but also at the same time uncertainty around food supplies. The presidency in Egypt is reasserting that, you know, they're secure for 6 months. Is there an opportunity to be had given the valuations? Because we've dropped a lot from where we kind of started at the beginning of the year.
We have, absolutely. You have the 5 years trading north of 800 basis points at this point. Yeah, Egypt has taken the right steps in the right direction. They've announced reform plans. They've had the inflows from the GCC. They've increased interest rates. But I think that headwinds are still significant, and the reforms that Egypt needs to do now are structural at this point, and therefore we think that it's too early to step in, given both the headwinds that Egypt is facing and the macroeconomic pressure that we are facing globally.
Could we get another push lower for the pound?
We could have a push lower, definitely, for the pound. I mean, the debate is that the IMF wants Egypt to let it be completely floating. The central bank is hesitant on doing that. And this is where I think the main question is going to be for the IMF deal to come through.
Credit default swaps, so we're checking those again. I mean, they're going up across the world because of the financial backdrop and how that's shifting and the liquidity that's being sucked out of the system. But in Turkey, I mean, we are seeing 19-year highs for credit default swaps.
Absolutely.
And the central bank and the government, they're trying to resolve inflation that is out of control. Run me through what the thinking is at our Comp Capital about what opportunities those difficulties.
We have been underweight Turkey for quite some time now. We have been underweight Turkey because of the unorthodox monetary policy. The government announced yesterday a measure to support the lira, which are revenue-linked bonds with quarterly coupon payment, and announced increased required reserves on loans that are going to consumer loan. We think that these measures are not enough because they're not addressing the structural devaluation of the lira, which is the growing current account deficit and the unorthodox monetary policy. With regards to redirecting loans, it's inherently impossible to be able to know who the end user is. So despite the lira dropping significantly, credit swaps and cash bonds dropping significantly, we still don't see Turkey as a buying opportunity.